International activities are subject to an increasing level of compliance and reporting obligations, and as such, international taxation has become more complex. Failure to report international activities accurately can result in severe consequences and harsh penalties. In this presentation, I'll discuss some of the more common reporting obligations involved with international taxation. A U.S. person is any U.S. citizen or resident. U.S. persons are required to report their worldwide income annually on Form 1040. This applies to citizens no matter where they live and to non-U.S. citizens if they reside in the United States. If the individual is subject to tax in another country, there is generally a foreign tax credit that can be claimed to offset all or a portion of the U.S. tax. Let's talk about some of the more common forms required in connection with international activities. FinCEN Form 114, more commonly known as the FBAR. This is an annual information report of any offshore bank or financial account, either by ownership or signature authority. The report is required when the highest aggregate value of those accounts during the year exceed $10,000. For example, if you own a foreign bank account with a maximum balance of $7,500 and another account with $3,000, an FBAR is required since the aggregate value of all accounts exceeds $10,000. The form must be received by the government by June 30th for the preceding year, and penalties are severe for non-filing, late, or inaccurate filings and can be as high as $100,000 or 50% of the highest account balance, whichever is greater. In some instances, criminal penalties can be assessed. Form 8938, Statement of Specified Foreign Assets, is used to report foreign bank and financial account balances, and the income and deductions derived from those accounts. It is part of the annual Form 1040 filing and is required for aggregate accounts of more than $50,000 on the last day of the year or $75,000 at any time during the year. For joint filers, the thresholds are $100,000 on the last day of the year or $150,000 at any time during the year. For citizens living abroad, the thresholds are $200,000 on the last day of the year or $300,000 at any time during the year. And for joint filers living abroad, the thresholds are $400,000 on the last day of the year and $600,000 at any time during the year. The penalty for non-filing of Form 8938 is generally $10,000 per year. Form 5471, Information Return with respect to certain foreign corporations, is used to report the ownership and activities of foreign corporations owned by U.S. taxpayers. Depending on the ownership percentage and whether there have been any ownership changes, the return may be required to be filed annually as part of the Form 1040. The most common scenarios that require filing are A, owning more than 50% of the foreign corporation, B, an ownership change of 10% or more during the year, or C, 10% interest in a foreign corporation owned more than 50% by U.S. people, commonly known as a controlled foreign corporation or CFC. Certain transactions and financial statements on the foreign entity are usually required, and a separate 5471 is required for each foreign corp owned. The penalty for non-filing of Form 5471 is $10,000 per year per form. Other forms include a Form 8865, which is similar to a 5471 and is required for foreign-owned partnerships. The reporting requirements and penalties are virtually the same as for Form 5471. Form 8858 is an information return required for foreign disregarded entities. The informational reporting is in addition to the reporting on the income and deductions on the individual's income tax return. Penalties of $10,000 per failure exist for non-filing of Form 8858. The Form 3520 is used to report gifts received from foreign persons in excess of $100,000 per calendar year, or gifts from foreign corporations or partnerships in excess of $15,358. It's also used to report income from foreign trusts as well. Form 926 is used to report contributions to foreign corporations in excess of $100,000. And finally, Form 8621 is used to report distributions from passive foreign investment companies like foreign mutual funds, or PFICs. Foreign taxpayers are subject to U.S. income taxes only on U.S. source income, but generally are not required to file the information reporting forms discussed earlier. They may be subject to U.S. withholding taxes on dividends, income from partnerships, rental income, and sales of real estate, unless there are treaty exemptions. There is also currently an offshore voluntary disclosure program in place for taxpayers to properly report the existence and income from foreign accounts and companies. In exchange for reduced penalties and criminal exposure, individuals are required to file 8 years of amended income tax returns and foreign bank account reports, as well as paying all income taxes due, together with interest and penalties. In addition, a penalty of 27.5% of the highest balance of the foreign accounts during this 8-year period is assessed. In certain circumstances, a taxpayer may qualify for a less severe streamlined disclosure, which reduces the 27.5% penalty for residents to 5% and 0 for non-residents. In summary, the area of international taxation has been a hot topic in recent years and continues to be increasingly complex, with new compliance requirements being consistently added. We are experts in this area and welcome your questions. We are always available to assist you with your tax needs.